Bismillahirrahmanirrahim. This is the first video on balanced scorecard. This video describes the balanced scorecard approach to performance evaluation, limitations of financial indicators to measure companies' performance, lagging and leading indicators, key indicators in balanced scorecard, strategy map for balanced scorecard, and finally an illustration to explain the balanced scorecard approach. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA and CMA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning on balanced scorecard. Let us start with the concept of balanced scorecard. Balanced scorecard is a way to measure the company's performance. It helps companies to identify and improve the internal operations. It was developed in 1990s by Robert Kaplan and David P. Norton. Traditionally, the company's performance is measured through financial indicators like higher profit, earning per share, return on equity, etc. In traditional measurement of company's performance, the focus is on profit rather maximizing profit. So if a company is earning profit or higher profit than its competitors, it is assumed that managers are doing an efficient and effective job assigned to them. Bonuses are announced on the basis of profit earned. So the focus of a manager is to ensure a high earning per share, higher return on assets, etc. So good accounting number means good managers and a good company. Unfortunately, not everything is fine in these financial indicators, as not every factor that affects the company's performance are incorporated in it. Think of the economy. If the economy is not doing well, the company may not be performing well despite the fact that it has good managers. It can be the other way too. If the economy is doing well, the company may be performing well despite the fact that the managers are not good managers. So there are limitations of financial indicators. For example, the stock price can be increased by having a higher earning per share. A manager, in order to have a higher earning per share, will try to increase the earnings and cut the expenses on research and development. He may lay off employees. He may ignore repairs and maintenance, at least in the short run, in order to reduce cost, and by doing so, the earning per share will go up and thereby the stock price. A manager can do this in the short term, but will the company's performance be the same even in the long run? And the answer is no. In the long run, the company cannot survive if they continuously don't invest in research and development or do not hold efficient employees, or do not regularly spend on repairs and maintenance. It is more a kind of pump and dump strategy of the manager where they can get bonuses, etc., in the short run, and once they have squeezed it, they leave the company in perils. Thus, if the company focuses only on the financial measures, the managers will focus on the short term rather than long term perspective. The manager will adopt the pump and dump strategy, drive the stock price in the short run, get all the benefits in the short run, and then leave the company. So, financial indicators reward only the top managers, while the frontline managers dealing with customers on the day to day basis suffer by earning per share or return on investment or return on equity, etc. The financial indicators are also called lagging indicators, as we know the result after the event. For example, in income statement, profit is calculated by deducting expenses from revenues. We get the result after the event has happened, and this may be too late to take corrective actions. That's why it is a lagging indicator. Not only this, since profit is an indicator of good or bad performance of the manager, he will either increase the selling price or decrease the cost to maximize the profit. He will be least concerned about its bearing on the customer satisfaction or employees' motivation. So the companies need not only the lagging indicators, rather they also need leading indicators. Companies are now using a new tool to measure the performance of the company called balanced scorecard, where we not only use the financial indicators to measure the performance but other indicators too. This does not mean that financial indicators are not important. They are definitely important, but they are not the only ones. Leading indicators are the critical success factors that signal how well the company is performing throughout the process rather than providing results in the end. The end result, like profit or loss, as indicated by the income statement, are easy to compute, but they are after the fact, and it is too late to take necessary corrective actions. The balance scorecard identifies three more other areas or critical success areas that are called leading indicators. These three indicators are learning and growth. They deal with the employees, their training, their motivation, etc. If employees are well trained, the company will have a better internal process. They can do the job better, they can produce a better product, they can serve customers better, and customers will feel more satisfied. As a result of which, the company will get good lag indicators. Thus, a company, in order to be recognized successful, balanced scorecard focuses on three components in addition to the financial indicators. The balanced scorecard recognizes that for the company to be successful, it needs to focus on four components: financial perspective, customers' perspective, what customers expect from us, how does the customer see us, what does the customer expect of us, what type of product they are looking for. So we have to listen to the customer and respond to the customers to be successful. The third perspective is internal process perspective. How well are we doing things that add value to the customer? How well are we manufacturing? How well are we serving the customer? Are we doing it efficiently? Are we doing it on a timely fashion? What can we do to add value throughout the process for our customer? Next is learning and growth. uh, that is training and number of new patents or products, sustainability, innovation, technology, and knowledge. So, are we investing in the employees? Are we training our employees? Are we creating new patents and new product? How well the employee are motivated to work for us? Do we have any innovation and technology and knowledge within our employees? Are we rewarding our employees? So, business scorecard is evolved over the years. As business changes, it has to change its perspective. Let us look at the strategy map for a balanced scorecard. Here are the four components. You can see that they are well integrated and is much broader than just financial perspective. Please note that financial perspective is the ultimate goal for the company and the stockholders. So the company will start with learning and growth. That means the company will enhance the employees' skills by training. So if the employees are in skills are enhanced, it will improve the productivity, which is part of the internal process. This will reduce the cost for each unit value stream, and at the same time it will improve the quality as well. If the company improves the use of technology by training the employees, the productivity will improve. And this will improve the quality as well. If the company is able to communicate strategies throughout the organization and reward the employees can improve the quality. The employees can thus improve the customer satisfaction because they know what the customers want. By this, the company can enhance product innovation. Thus, as the company train their employees, reward and motivate them, the internal process will improve, and so the product innovation, thereby improving customer profitability. As the company can make better product and deliver better customer satisfaction, the company can charge the customer to pay them more. Thus, by making a better product, the company can charge the customer more. That will mean more profit. Improved productivity. That means reducing the order filling time. So the customer will receive the item early. That will make them happier. Now, since the quality of product has improved, it will improve customer satisfaction. That will enhance product innovation. That will further improve the customer satisfaction. So the company started with training the employees, then communicated what the company wants from them, then motivated them by rewarding them, in turn improve the quality, that made the customers happy, leading to increase in revenue and decrease in cost. All this will increase the return on investment. And thus the company has achieved the financial results and make the stockholder happier. So remember that the old method focuses on the financial indicators while the balanced scorecard considers three more indicators in addition to financial indicator. Let us now talk about it with the help of an illustration. This is an illustration of Southwest Airline, and as you can see that the company's objective is to increase profitability, have more customers and have fewer planes. They also want to have flight on time. They want to have the lowest prices. They want to have fast ground turnaround. So they want that the customers board and disembark quickly, and they want employees to be trained. The first objective is ground crew alignment. Southwest Airlines want to make sure that its employees are doing a good job on the ground. So the company must provide training and motivate them to work efficiently and effectively. This will be measured by providing ownership of stock to the employees. So the company will provide stock ownership of maybe 100%, 100 shares or 50 shares to its employees, so that they feel that they are the owners of the company. So this is how the company will measure its goals. The target is that the company will train 70% of its employees in the first year. In the third year, they will train up to 90%, and by the end of the fifth year, all the employees will be trained. The initiative taken by the company is providing employees stock option plan and ground crew training. So if a company is able to accomplish this in the 5 years plan, they will have a fast ground turnaround. So this is the internal process. This will lead to on-time ground on-time departure and on-time ground. And the target is that the departure and arrival is within 30 minutes and for 90% of the flights. The company's initiative in this regard will be to have a cycle time optimization program to monitor the time and make sure to reward employees based on that initiative. So Southwest Airlines is able to shorten the arrival and departure time by 30 minutes, and this will make the customers very happy. As the assumption is, as long as the flights are on time, the airline offers the customers lowest price. As now the company is saving money for flight or time and charging the lowest price, thereby making the customers happy, the company is able to retain its customers rather than the existing customers will bring more customers. This will be measured by monitoring the FAA, that is Federal Aviation Agency on time arrival rating, and the target is to be the number 1. Not only this, the company's target is to be ranked number 1 by the customers, and this will be monitored by them through market surveys. The company's initiative will be to have quality management program and customer loyalty program just to make sure that the customers are happy. Thus, if the employees are trained, customers are happy, the company will be able to achieve its ultimate goal, that is lower price and increase revenue. If customers are happy, they will buy more tickets and the company will have higher profitability. So the company is able to earn more profit, have more customers, and fewer planes. Fewer planes will reduce the maintenance cost and it will make easier for the ground crew to manage the planes. The company will measure this by determining the market value, the seat value earned, revenue earned, plane lease cost, etc. And the target is to have 30% compound annual growth rate of profitability, 20% of compound annual growth rate from seat revenue, and 5% decrease in cost. So the balance scorecard emphasizes that to achieve the financial goals, we should start from the bottom. Look at the employees and move upward, and eventually we will reach the target. Once the strategic theme is mapped out, objectives, measurements, targets, and the initiatives are defined, now run this program for a year or two to find out if this plan is paying off. If not, stop it and redefine the matrices. Change the factors that are more appropriate. Find out factors that will improve the internal processes and make customers happy. If the matrices is not working, it doesn't mean you are wrong. It simply means that it is not driving the revenue or reducing the cost. Rethink about it. Collect data for what you have to train the employees. Collect data on how to monitor the process. Collect data on what makes customers happy. Look into whether a lower price is increasing your profitability or whether the company is perceived as a high quality company or not. In summary, the balance scorecard does the following. It employs both financial and non-financial measures. It creates linkages so that high-level corporate goals can be communicated all the way down to the shop floor. It provides measurable objectives for such non-financial measures such as product quality rather than vague statements such as you would like to improve quality. It integrates all the company goals into a single performance measurement system so that an inappropriate amount of weight will not be placed on any single goal. So this completes our discussion on balanced scorecard. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.